Hi, everyone, and welcome to this week's edition of What's Driving Token Prices. I'm your host, Katie Talati, Director of Research at Arca. For those joining us for the first time, I'm responsible for identifying and analyzing digital asset and blockchain opportunities for Arca's funds. As part of our research, my team and I examine token prices and the market events that act as catalysts for price change. Based on our research and market events over the past week, here's some notable token price moves and what we think drove these moves. As a reminder, this commentary is not intended to be investment advice, investment research, or an investment recommendation. Please consult your investment professional for your own circumstances. Well, everyone, welcome to quarter three of the year. We're officially into July, and we have plenty going on considering it's summer. So just in the past few days, Sony has announced that they're going to be launching a crypto exchange based on a acquisition that they made a couple years ago. Not really sure what they're going to be getting out of this, trading electronics on the blockchain maybe, but that is coming in the pipes. The other big news is that end of last week, the U.S. Supreme Court overturned a ruling called Chevron, which basically allows federal agencies to kind of read between the lines and make judgment calls on regulations when there's like a gray area, instead of kicking it back to Congress. This is particularly important in crypto, most think, because the SEC has taken a lot of the readings on securities laws and kind of interpreted them in their own way and applied them to crypto. So the thought is maybe this will lead to a more favorable regulatory environment, and I guess we will see. At the same time, however, the SEC ended up slapping a lawsuit against Consensus/MetaMask, accusing them of being an unregistered broker-dealer because they were selling swaps, or basically they were allowing people to stake their ETH, but they were doing so by placing it with Lido and MetaMask, Lido and Rocket Pool. And this, supposedly what they've been doing with issuing the staked ETH derivative is that they are issuing unregistered securities. So I'm sure that will make its way up the court. Consensus is very well funded, so we will see how this unwinds. But today we're going to talk about some tokens as usual. So I will get started with talking about Pendle. So Pendle is a DeFi yield management protocol. They basically saw their token tank the past few days as about $3 billion, or 50% of their TVL left the protocol. So Pendle saw a lot of growth in 2024 due to the rise of eigenlayer liquid restaking protocols and liquid restaking tokens, or LRTs for short. So I know I've talked about this a lot, eigenlayer, and it can be kind of confusing, but eigenlayer is the idea that you can use tokens to essentially provide security outside of, basically you can use Ethereum to provide security outside of just securing Ethereum base layer chain. So if you have a layer 2 running on top of Ethereum, you could also stake Ethereum tokens that are already staked on Ethereum's base chain to guarantee that security. A lot of mixed feelings on this. This is very novel, new, like I said, kind of just launched in the last year. So we're getting used to it. But as a result, like we had liquid staking tokens on base chain ETH, we now have liquid restaking tokens. So people can have a derivative of whatever they have staked on eigenlayer. Now, so the big issue with that is that a lot of the liquid restaking grew in a big way because there were a lot of incentives. There were new liquid restaking protocols that issued their own native token, and there were eigenlayer points. And so people were just earning more and more points by essentially airdrop farming these protocols. So this was a huge boon. TVL really flowed in a ton. Pendle, like I said, and basically offers users the opportunity to maximize those yields and to kind of set up different markets to get liquidity on whatever yield-bearing asset they have. So Pendle, has done pretty well, but this outflow of TVL came as a bunch of markets for Pendle expired last Thursday. And then what happened is that for a lot of these liquid restaking tokens, a lot of their initial airdrop farming has kind of come to an end. So a lot of them are not offering as big of token incentives or rewards right now. And so a lot of users are very mercenary, right? And so they've said, well, I don't really want to sit here and, farm for 10% rewards. I want to go somewhere else and earn 30, 40%. So as a result, we've seen this massive outflow in TVL. So that unfortunately has led to Pendle's token price going down 28% just this week. Okay, next up we have a 2-for-1, Blur and Blast. So last week, the long-awaited airdrop for Blast was released to an initially disappointed community. I don't know how many times I talk about a disappointing airdrop a week, but here we are. Okay, so Blast is this layer 2 project. They were created by Blur, the leading NFT marketplace, and they were originally considered to be this top up-and-coming ecosystem. A lot of people were really excited about it. They introduced the idea of native yield, where users could essentially contribute ETH to Blast, and Blast was going to go and take that ETH, stake it on Ethereum mainnet, and return users like real yield. Basically, they were earning ETH yield, not just and Blast tokens for staking on the chain. So this led to a huge influx of TVL into Blast. A lot of people were really excited about it. Blur's NFT marketplace said, hey, for this this airdrop farming season of rewards, you have to stake your Blur tokens and you can earn Blast tokens as a result. So this came as a big disappointment because they really, the team really hinted at the time that like staking Blast or staking Blur would earn them a lot of Blast tokens. And of course, the airdrop allocation came out last week before the airdrop. And they ended up only allocating 0.5% of the overall supply to Blur stakers. So that was a big disappointment because a lot of people have been staking for over 6 months. The Blast staking and Blur staking all started end of last year. So it was a while to kind of be locked up, but this was, really unfortunate for most people. So expectedly, the Blast token has suffered since launch, as has Blur token, as people have unstaked and sold, and they are down 21% and 11% respectively for the week. All right. Next up, we will talk about AAVE. So AAVE, the decentralized money market protocol, has been expanding their reach this past week. The first big thing is that they announced that they're in the initial governance vote to deploy the protocol on Aptos, which will be their first non-EVM chain. Many are speculating that they might have SWI sometime next year. We shall see. The other big thing is that they officially launched the Go stablecoin cross-chain yesterday, launching on layer 2 protocol Arbitrum. So both of these items are kind of part of their V4 launch, which is later this year, and it's basically promising to create a cross-chain liquidity marketplace. Right as of now, like you can't take out a loan on Ethereum and get the assets over to say Aptos, or you can't take a loan out on Aptos using assets you have in Ethereum. So the idea is that they were going to be creating this marketplace that overall can allow you to source liquidity from different places and manage like a lot more of your DeFi in one hub. So we'll see how this actually gets done in practice. We'll see what steps, what hurdles AAVE has to face, but they're still one of the biggest DeFi protocols with a ton of TVL and a lot of usage. They're only down 2.5% for the week. All right. Last up, we have Polkadot. And so if you haven't heard about this before, Polkadot is they're a layer 1 protocol, just a little bit of background on them. They were started by Gavin Wood, who is one of the co-creators of Ethereum. He left the Ethereum project, wasn't happy with the scaling roadmap or how it was going. And so he said, I can do it better. I'm going to raise some money. I believe he raised in 2017, 2018 at the time. It was multiple hundreds of millions of dollars. Lots of big investors backed him. And the project has launched, but it really hasn't they've kind of struggled to gain traction and mindshare in the space. However, this week they made headlines because there was reports that their on-chain treasury has spent about $87 million in the last 6 months alone. So basically this on-chain treasury wallets show that the project only has 2 years worth of runway left at its current burn rate. Now that's kind of like a silly metric because apparently Polkadot, the on-chain treasury, takes a percentage of all the inflation rewards going forward. But think about it, as the price of Polkadot token goes down, you are essentially reducing their spending power. So this was obviously a lot of people latched onto this in the market as they're not doing a good job spending or keeping their finances in line. Obviously, a lot of people are like, what are they spending $87 million on? And they don't really have that much to show for it. So some of the eyebrow raising expenses included a $50,000 animated logo for CoinMarketCap's website, $6.8 million sponsoring a prestigious soccer club, $1.9 million sponsoring the race car driver Connor Daly, and $1.3 million to sponsor the esports organization Heroic. So, like I said, while the dwindling treasury might be a cause for concern, for some reason, Polkadot is up because this is the first time people are talking about it in probably about a year. And it is up 6% for the week, which in a week where everything is down, pretty impressive. All right. That's all I got for you guys this week. I hope you enjoyed our insights. Tune in here again next Wednesday at 1 p.m. Pacific to hear